All right. So welcome, everyone. Thank you for joining the session we have. My name is Joe Duggan. I'm chairing the concurrent session that we're holding here on energy investment. We have a lot of great presentations and speakers lined up. So first, we'll be hearing from Naielly Marques. We'll have 20 minutes for presentation, followed by 5 minutes for Q&A. So thank you very much. And Naielly, please go right ahead.
Thank you very much, Joe. So I'm Naielly Marques, a PhD candidate at Pontifical Catholic University of Rio de Janeiro. And I'm going to present this paper, whose title is Decision-Making Model on Hedge Transactions in Electrical Energy Commercialization. So, oops, the end of the presentation. So to put this, the topic of this article in context, we emphasize that agents of the electricity sector, such as generators, traders, and consumers, may often find themselves in a short position in the market. So this may occur for several reasons, such as deficit in power generation due to the low levels of natural energy inflow, in the case of hydroelectric generator, or because of uncertainty in wind speed in the case of a wind generator, or for speculative reasons in the case of a trader, and even delays in the construction of a new power plant. So, because of this, these agents are obligated to purchase their energy shortfall in the spot market to fulfill their sales contract commitments, and this exposes them to price risk. So one alternative to these agents is to have this risk by entering into forward contracts in which the exposed agent can contract part or all of their position at a preset price. But if the hedge is only partial, the non-hedged balance must be settled at the spot price at maturity. And this exposes the agent to the risk of energy price variation. On the other hand, if we have a full hedge, we eliminate the risk, but also eliminate any possibility of gains in case of price movements in the spot market. In this sense, we want to analyze in this paper the decision making on the hedge operation, aim to maximize the agent's profits subjected to a certain level of risk protection. And we assume here that these agents have a risk aversion. So we believe that the contribution of this study is to develop a decision support tool to determine how much an agent should purchase of its short position based on his willingness to pay the risk premium and the cost of this transaction. So we let me put this here. We adopt this preference function that was developed by this author in 2016. And this function allows modeling the variation of the risk aversion level of an agent for different preference ranges. So this function is composed by lambdas that represent a measure of investor risk aversion, the expected value of financial position X, and the conditional value risk of this financial position. And we have different lambdas and different alphas in our model. So since we are considering that the agent is in a short position in the market, we construct this financial position equation. So here we have the percentage of the purchase decision of the hedged transaction. Here is the spot energy price. Here is the future price estimated by the forward energy price curve. Then we also consider opportunity cost of this transaction. And we multiply this, all these parameters by the uncontracted amount in each month and the number of hours in each month. So from this expected utility function, we can also define the certainty equivalent and the risk premium. And the certainty equivalent reflects the situation of the agent's indifference between hedging and being exposed to the energy price risk. And the risk premium is the difference between the average of the financial position X and the certainty equivalent, which represents the premium required by the hedge transaction. So after presenting this model, we have also to determine the parameters, the alphas and lambdas. So we determine the limit of change in the level of risk aversion of the investor and its degree of risk aversion in each range of results in relation to the others. So since it's a relative aversion here, we recommend to use parity comparison method, and we choose to use analytic hierarchy process to determine the alphas and lambdas. And this method was proposed by Saati, and he recommends to follow these steps. So the first step, we define the problem, the objectives, the existing alternatives, the decision-making criteria, and we select the decision makers. After this, these decision makers ponder the importance of each of the criteria in relation to another, forming a matrix of judgments. Then we normalize this matrix of judgments and we find the matrix of preferences, and then we define the lambdas. So to evaluate the robustness of this model, we consider this index and ratios. The first one is the average consistency index, and the CR is the consistency ratio. So Saati says in this paper that if the result of the consistency ratio is equal or less than 10%, the parity comparison matrix has acceptable consistency and the weights are valid and can be used. So we test this in our model. And to verify the validity of our model, we consider a case of a major agent in the Brazilian electricity sector that needs to make its head decision for the second half of this year. And here we assume two scenarios. The first one is that he makes the head decision in July to cover its exposure through September, and he makes another decision in October to cover its exposure through the end of the year. And the other scenario is that he makes the head decision in July to cover its exposure throughout the entire second half of the year. And here, our main objective is to define the optimal head level that maximizes the agent's profits conditional to a certain level of risk protection in each of these blocks: July to September, October to December, and July to December. So for this, we consider a fixed opportunity cost that I said in the financial position X. And here we assume that it is equal to 201 reais per megawatt hour. And we also assume these values, which are the uncontracted amount in each month, the forward price in each month, and also the number of hours in each month. Then we also assume that there is a proxy for energy price in the spot market, and we use the monthly simulation made by National System Operator for the year 2021 for the Brazilian energy market. And we have here the average spot energy price in each block and the weighted average of the uncontracted amount in each block. So after this, we establish two target levels: the intermediate risk and the extreme risk. we assume that the intermediate risk is the expected outcome of the worst 30% scenarios and the extreme risk, the worst 5% scenarios. And then we obtain the alphas. We calculate the conditional value risk at 70% and the conditional value risk at 95%. Okay. So with this, this intermediate risk, the extreme risk, and the expected value of financial position X, we use the AHP and the 9-point SAD scale to find finally our lambdas. And this is the matrix of judgments that are established by the team responsible for the head decisions of these major agents that we are analyzing. Then we normalize this matrix and we find the weights matrix and also the criterion weights and the consistency. To test the robustness of our model, we calculate the CR, as I said, and we find a CR that is less than 10%, and we demonstrate the robustness of our model. After this, we could calculate the probability and the probabilistic weight, and finally the lambdas of our model. So here we finish our parameterization of our model. So considering these assumptions, we optimize the financial position X in order to estimate the percentage of the purchase decision of the hedge transaction in each of the blocks under analysis: July to September, October to December, and July to December. Then we also calculate the certainty equivalent, the risk premium, and the value that the agent is willing to pay for this hedge transaction in each block. So here are our results. And first of all, this is our main result. This is the optimal percentage of the purchase decision of the hedge transaction. Here we have mean, which is the average of the financial position X. Here is the conditional value risk at 70%, and the conditional value risk at 95%. This represents the average loss incurred in the 30% worst case scenarios, and here the average loss incurred in the 5% worst case scenarios. Then this is our certainty equivalent in each block, the risk premium, and the value that the agent is willing to pay for the hedge in each block, which is defined as the sum of the average spot energy price with the risk premium. So our results show that if the agent chooses to make the hedge decision in two stages, July to September and October to December, he should contract 100% of the uncontracted amount in the third quarter, which represents almost 55 megawatt on average, and not hedge at all in the fourth quarter. So here is these results. And on the other hand, if the agent chooses to make the hedge decision in July to cover its exposure throughout the entire second half of the year, the model suggests to purchase 54% of its position, 45% of its position. And this means that the optimal decision in this case is to buy almost 30 megawatt hour in average, which is 45% of the contracted amount in the second semester. And he should contract this for up to 325 reais per megawatt hour, which is this result here, the willingness to pay. So we believe with this model and this paper that we propose a decision support tool that allows agents that are in a short position in the electricity market to make an optimal decision on hedge transactions. And although we believe that our model is robust and we run some tests to validate our model, we also have to emphasize that we have limitations, and the main limitation derives from the fact that it's difficult to determine the parameters of the preference function, and we recommend further studies on this issue. And that's it. I think that is on time, right? And I'm open to answering your questions.
All right, Naielly, thank you very much for a very interesting presentation. One question that I had, you addressed it towards the end about the difficulty of thinking about parameterizing the preferences there. Do you have any idea sort of to what degree that's going to be influenced by sort of the available generation mix? So if you think about how the risk and things like that are impacted by, so the intermittency of renewable generation, right? So what do you think that might have to say about what you're studying here? Is that clear, or was I?
Yes, I think the main difficulty here is that we cannot generalize this result, because we analyze a certain agent which has its own preference risk, a preference function, and risk aversion. So we cannot say that these lambdas, these values, could be used for another agent in the electricity market. But we can say that this model is robust to be applied for other agents.
All right.
Right?
No, thank you. Thank you. Do we have any questions from any of the other members of the session?
Jonas is also my co-author, so he understands what I'm saying.
Yeah.
If he wants to complement, feel free.
All right, well, if no one has any objections, I'll start my presentation then. Does that sound good?
Yeah.
So before that, I want to say that I need to leave this section, and it was a pleasure to present here. And thank you very much, Joe, and the other Mariana, and the other authors here. And what?
I said thank you very much for presenting.
Yeah, thank you.
Thank you, Naielly.
Okay.
Thank you.
I'm going to my visa appointment.
Good luck there.
Thank you very much.
Bom courage.
Bye-bye.
Bye-bye.
All right, so now we have Jesse Kaczmarski presenting public support for community microgrids. So Jesse, please take it away. Thank you.
Thank you very much, Joe. Good morning. Well, good morning from me to everyone else, wherever you are. And today I'll be talking about the public support for community microgrids. So this is a very different approach to energy investment that we don't really see a lot of in the academic literature. And that is, what is the consumer perspective on energy investments and infrastructure decisions? And so in order to approach that problem from a consumer's perspective, you often run into things like original research is required specifically on your study area. And so in this case, I'm going to kind of motivate this problem a little bit. And so the United States specifically is rapidly modernizing its electric grid. It's a little bit behind the curve because there is a large electric grid and there's a lot of political issues with this infrastructure investment, but we're on the road there. And ever since the mid 2000s, this has really become a forefront in terms of infrastructure spending. And it's specific to the American Southwest, where renewable potential is extremely high. The policy objectives are becoming more and more focused on renewable generation. And so, for an example, in New Mexico, where I am based, our state has decided to go carbon free in terms of electricity generation by 2045. And they actually believe that they can get it done sooner than that. And then there is also this issue of a rising natural and man-made disasters, specifically in the United States, that are impacting the electrical grid. The things that impact this are such as climate change. And there was one study that showed in Arizona, the neighboring state to New Mexico, for every 1 degree Celsius increase in ambient air temperature, you're going to be seeing 30 times more power outages and higher probability of cascading failures. But also the infrastructure will require 3 times as much maintenance. And so there becomes this need to harden the electric grid and insulate it against these disasters or high grid stress events, and also to take advantage of distributed energy resources. So in the Southwest, rooftop solar and things like that are becoming very common and very popular. And so we need a better infrastructure system to take full advantage of that. And so the community level distribution feeder microgrid becomes a potential solution. And that solution is to include these community microgrids at the localized level, and that can connect to critical infrastructure, but also homes, and provide resistance to outages. And so, like, what is the problem, right? So why am I even doing this study? And where is the gap? And so the public regulatory bodies in the United States, they oversee the pricing and capital infrastructure investments. And so what the utility will do will present a infrastructure investment capital project, and this public regulatory body will either vote to approve or disapprove this project. And with that comes a cost benefit analysis. They must show that these projects are net positive. And the problem with those is there is a broken link between the community's demand and support for it, because a lot of these cost benefit analysis don't include original research into the non-market benefits of infrastructure investment. And so that question becomes, what is a public demand? How much are they willing to pay for this infrastructure investment? Because at the end of the day, this infrastructure investment does come back onto the customer in terms of higher surcharges and rate increases. And to be specific and upfront, this presentation only considers the residential respondents. The residential consumers often pay the most in terms of electricity per kilowatt hour. And they also have rate increases as a result of infrastructure investment. And then to really hit the point home, there is no current research on the public demand for these community microgrids in the Southwest, and dare I say even the United States. There is just no contingent valuation evidence for or against this. And so this becomes the first paper to really use contingent valuation to evaluate the need and demand for microgrids as a potential solution. And so the question becomes what is that public demand for community microgrids in Arizona, Colorado, New Mexico, and Utah? And I will call these states the four corners because they all touch at one point and they all share a lot of similar regional and geographic characteristics. But there's enough heterogeneity between the states in terms of political ideology, income, education, things like that. And so you get a really rich region of the United States to analyze. And so what are So what I did was conduct a survey, right? So I used a web-based convenience sample where I used a company called Qualtrics. I don't know if they operate outside of the United States, but I created a data set of 4,782 people who were sampled online from August 2020 to January 2021. And first and foremost question that I get is, okay, you're running a CV during COVID, right? How does COVID impact your responses, right? Well, that was controlled for. I'll talk a little bit more about that towards the end of the survey. But the reason we use CV is because power infrastructure provides not only direct, but also indirect benefits. And so those can also be considered market and non-market values. So the use of the market values you might expect is that if you're using distributed energy resources at the microgrid level, the cost of electricity might be lower. Marginal cost of electricity would be lower. But that's directly measurable through the market. And then there's also these non-markets. So what is the existent value? Like how much would people be willing to pay just because it exists in their neighborhood? You know, these little things that you can't really parse out with market data make contingent valuation a perfect use case here. And so what I also did is I collected a bunch of observable characteristics, such as attitudes and preferences towards electricity use and the relationship with their electricity provider, because all these things impact public support for infrastructure investment. Ideologies in terms of cost sharing, political, and then also socio-demographic information. And then I conducted a valuation exercise, which is a referendum style closed-ended valuation exercise. And then I included a variation in scope, which splits the sample down the middle. And I'll discuss more about that a little later. And then I elicit the median willingness to pay for a community microgrid across the four corners. And then I do a heterogeneity analysis at each state and for the customers of each ownership structure, because I assume that there is some sort of relationship between the ownership structure of the utility and the customer. And so for the responses, you can see this map. This is zip code level responses. This looks a lot like the actual distribution of people in the four corners. There's a lot of counties where you couldn't get responses from because honestly, not very many people live there, maybe 100 or two. And so that's just an example of those. And the empirical approach, just to keep it high level and to keep the presentation at a reasonable amount, I survey the region and then I conduct a logit analysis of the results from that survey to estimate the willingness to pay, and then to conduct a heterogeneity analysis. So the logit analysis and the willingness to pay estimation that I use comes from Cameron and James and Hobb and McConnell. And there is a lot of other things going on behind the scenes, and I love to answer some questions about that. But I reduce heterogeneity or hypothetical bias and things like that using Actor 2008's methodology and Carson et al. 1998's NOAA panel recommendations. So respondents were informed during the survey of what a community microgrid is and what it will do for them, the benefits and costs of the microgrid, why their opinion matters. And that's a really big one, because a lot of consumers, especially residential consumers, aren't often asked about infrastructure investments, whether they would support it or not. And then we gave them real world examples of these community microgrids. In the United States, these commonly exist in California or rural parts of Alaska, and provide benefits to those communities. And we give examples of exactly those and how they were successful in building resilience or reducing the probability of an outage. And then they were asked to participate in the valuation exercise. And so this evaluation question, right? Respondents were asked to vote on a referendum, this hypothetical referendum, and they were asked to approve the installation of a community microgrid contingent on a monthly increase in their customer surcharge for 24 months. So this is supposed to represent the increase in their bill to pay for the microgrid installation. But also, they were given a level of benefits that they would receive from the microgrid. And this is where the split sample survey comes into play, this variation in scope. So there were two variations in scope. There was a direct benefits group and an indirect benefits group. Respondents taking the survey were randomly placed into those groups. And if you were in the direct benefits group, then you saw that the microgrid that you were being asked to vote on would give you your home and your local critical infrastructure connection to that microgrid. And that critical infrastructure are things like the police station, a hospital, a local grocery store, etc. And then the indirect benefits group were told that the microgrid would be installed on their electric grid, but not directly in their community. And so their home or their local infrastructure would not be directly tied into this microgrid. But there would be a likelihood, a reduction in the likelihood of disruptions. May there be a grid stress event where there could be rolling blackouts and such. And so what you would expect from this, from an economic standpoint, is that respondents who saw the direct benefits group would be willing to pay more for the microgrid installation than those who were not. And then the surcharge that they were asked to pay for was randomly selected from a bit, well, it depends on what you want to call it, but a payment level design that was based off of the study region's monthly electric bill. And I'll explain that here. And so you see this is the voting behavior for this microgrid installation. And these are the payment levels that were available. So there were 8 and they were randomly chosen from a uniform distribution. And people were able to respond to that surcharge increase in addition to that variation in scope they were assigned. And so you see this column here, the second column is respondents participating in the valuation exercise who were in the indirect group, and then the direct group here. And so what you would expect to see, and what we see here, is that respondents in the direct group are much more willing to vote for the program. And this isn't the raw results, because I included what's called a certainty recoding scheme. And this is a way that economists reduce the hypothetical bias of a contingent valuation, where after the valuation exercise, we ask them, how certain on a scale of 1 to 10 are you in your response? People who say they're 50% sure in their yes response really aren't sure, right? And so what we do here is we recode anyone with 50% and less as a 0. And these are the results of that here. And so the raw results, where there was no certainty recoding, saw a much higher percentage yes votes than what you see here. But these are expected to be more robust, or whatever the term is for real, I guess. These are much more likely to be the real results. And so after doing the logit analysis, which I have in an appendix and would love to go over, I estimate the median willingness to pay estimates. I use a median willingness to pay to remove any outliers, or to reduce the bias of those outliers. And you can see across the region, the indirect group is willing to pay about 58 cents per month for that 24 months, and the direct group is willing to pay almost double. And so that's what you would expect to see. And these estimates are in line in terms of surcharge increases and percentage of respondents' bills. And then I did a state-based heterogeneity analysis to look at the differences that people would be willing to pay depending on what state they lived in. So people in Arizona are going to be very similar to the Four Corners result, and the same goes for Colorado. New Mexico has an interesting response in that people in the indirect group are willing to pay more than the direct group. There is a lot of interesting things about New Mexico that could be causing this. And it might have to do a lot with the rural-urban divide, also income and education divide that exists here. But I'm still working on parsing out why exactly that is only true in New Mexico. And then Utah has the highest willingness to pay for this energy infrastructure, coming in at $1 for the indirect group and $1.62 for the direct group. And then I break out the median willingness to pay estimates by the ownership structure of the respondent's provider, because this is really important in the United States, in that oftentimes people hate public utilities, especially so if their utility is a profit-based model. And so the investor-owned structure in the United States accounts for most residential customers, but the least number of utilities, right? So they have all the people under these small investor-owned or these large investor-owned companies, and they show that the responses are almost exactly in line with the Four Corners estimates. That might be driven by the fact that 78% of our sample lived in an investor-owned regional trade a regional sales territory of an investor-owned group. Cooperatives saw a smaller amount on the direct group. And there are lots of different reasons that you could see these smaller variations. And then the municipal group also saw smaller willingness to pay estimates than that of the investor-owned. So what was really interesting to me as a researcher is to find that people under the investor-owned structure are willing to pay more. That does not necessarily mean that there is a correlation between being an investor-owned and willing to pay more. There could be cross correlations between people who are in an investor-owned structure might earn more money because maybe they're in a certain area like Denver, Colorado, or Salt Lake City, Utah, these large metropolitan areas. And so those are extra correlations that need to be parsed out. And then those can also be parsed out by the regression results from the logit that are in the paper and not in here because it's just far too much for a 20-minute presentation. But that wraps up mostly what's been going on here. So the first research, this is the first research that attempts to evaluate this public support for microgrids using contingent valuation in the United States. So across the four corners in this 24-month period, people who would be receiving direct benefits would be receiving or would be willing to pay $25.44 for the microgrid, and those in the indirect group would be willing to pay $13.92. And so this provides a baseline analysis of ratepayer willingness to pay to be used in cost benefit analysis. And this is really important because there hasn't been any research into this that is publicly available on the academic level for utilities to use in evaluating whether or not they should pursue these community microgrid installations. And so this provides weight or not provides weight towards these installations, these infrastructure decisions. And this study also harps a lot on the need for utilities to conduct original research into their customer base, which doesn't get done very often due to the cost. So having just run this survey, I know it's extremely expensive, but luckily enough, I was able to use GIS to map respondent zip codes to specific utilities. So some of the larger utilities in our area are Pacific Corp, Public Utility of New Mexico, Arizona Public Service Utility, or something like that. But I can actually run sub-sample analyses on respondents who live in those, under those ownerships, those public utilities. And so that could actually even create more of a higher resolution result. And that can help them in their responses in terms of infrastructure investment decisions. And then another thing that has yet to be explored, but will be explored in the paper, is that we asked the question, would you be more likely, less likely, or about the same? Would you be willing to change your response if the microgrid used only renewable electricity, right? So in the Southwest, we find that people automatically assume microgrid or infrastructure investments to be somewhere in the realm of renewable electricity. This is due to the high renewable electricity potential in the region. And then also that there are no coal plants being built anymore. There, things like that just aren't happening in here. So people automatically assume that microgrids are renewable, but we told them in the information section that only a very small portion of microgrids are fully renewable. A lot of them have diesel generators or backups like that. But what we find in the survey is that 55% of the people who said no or not sure to the investment decision, the referendum, would be more likely to vote for that microgrid if it will use entirely renewable electricity. And so this changes the game a lot. And so this actually opens up a lot of research into the future on the willingness to pay not only for microgrids, but fully renewable microgrids that use battery storage, solar generation, et cetera. Yeah. So that about wraps up the presentation. I have a lot of appendices. If anyone has any questions, I would love to start answering them.
Jesse, thank you very much for a very interesting presentation. First, I've got a couple questions. The first one, that 55% of no or not sure, is that after the, you do the same adjustment there about certainty? Did the respondents have to answer that on that scale of like 6 or more, or is it?
So, yeah, so the numerical certainty score was only asked after the valuation question. And then after the valuation exercise, then this question was asked, how much more likely would you be willing to, vote for the program if it were renewable? Okay, that is limited in a way. We should have asked a follow-up certainty question regarding this, but yeah.
No problem. So
and that's actually really interesting, because that brings up something I hadn't thought about, is there might be a correlation between people who are more willing to vote for these programs and being less certain about their responses. So I should definitely look into that.
Oh, great. Another question I had about, I think it was table 2, if
Sure.
you could talk back to that.
This one?
Yes. So I don't know, in general, the four corners states that of the four, do you know which is the most populous, and is that reflected in your respondents? I don't know, I have no idea what the breakdown is across those 4 states in terms of the population that lives there.
Definitely. So Arizona has the largest population of this area, just because of Phoenix and that locale. New Mexico and Utah have a very similar population, and Colorado is larger than both. So in terms of population breakdown, it's New Mexico, Utah, and then Colorado is higher, and Arizona is the highest. And so there's a lot of sway in this, right? So there's a lot of, Denver, Colorado, and Phoenix and Tucson, they're relatively high income areas, especially for the four corners. And so you get a lot of skew from those. But we do, in the regressions, we do control for that. Yeah.
Okay. And then one last one in your table 3.
Here we are.
The investor owned versus cooperative versus municipal. Are those more common? So is Arizona have more investor owned, or Colorado has more cooperative? Was there anything interesting by state in terms of how those things looked?
So I haven't looked by state, but I can tell you from just living in the region that it's going to be investor owned is going to be dominant across all 4 states, just because of the large population areas that live in investor owned areas. Cooperatives are not as common. They seem to be the least common in terms of customers covered. While there are many cooperatives, they cover a small amount of customers. And then the municipal is going to be a little more common. Those are going to be more rural towns or very dense locales. But investor owned does seem to be the dominant in terms of percentage of customers. I haven't looked across. So this table 3 are results for the 4 corners entirely. I haven't looked at the ownership structure level at the state level. I haven't done that yet. I think that would actually, make the survey sample really small, because each one of these regressions is only half the sample, right? And because I tried to do it where I use, the direct and indirect group as like a dummy variable, but that actually has a lot of problems with the actual willingness to pay estimation procedure that I used from Cameron and James, in terms of the error terms needing to be multiplied together. So it just makes more sense to run it, separately. So when you start breaking it down further and further, you start running into really small sample sizes.
Yeah, I was just curious. Thank you. That was
no problem.
That was great. If there are any other questions from the other panelists in the session.
Oh, and just a heads up about the covariates that I used. I had 1, 2, 3, 4, 5 main categories. So this is their electricity use and provider relationships, attitudes and preferences, some ideological question, household characteristics, and sociodemographics. I really tried to be smart about how I developed the covariates to be used here, because you don't want correlations, but you also don't want to throw in covariates that aren't going to impact a person's response to the referendum. So like one of the things that I came into this with was, okay, I need to throw anything that has to do with electricity use, I need to throw that in there. That necessarily doesn't correlate to whether someone's willing to increase their surcharge, right? And so it was fun, interesting, but yeah. Okay, if there's no other questions, I mean, I'll just end it here.
All right. Well, thank you very much, Jesse, for a very interesting talk. Appreciate it.
No problem.
And so next up, we have Seyyedreza Madani.
Yeah. I will share my screen and then start presentation. So I guess you see my screen, right?
Yes, it's just not in presenter mode. We can see the rest of the. That's better. Is it? Can you still widen the view, or is that okay with you, Joe?
So is it okay?
I can see it all right. If everyone else is
Okay,
everyone
yeah.
is that okay? All right.
Perfect.
For me, it's okay.
Okay, great. So hi to all, it's Reza, and this work is a joint work with my supervisor, pierre-olivier, and is done with two other companies, Osiaco, a Montreal-based company, and a main distributor in Vermont, the Green Mountain Power Distribution Company. So this is the outline of my presentation. I will introduce the problem. We will go through the mathematical models, and we will see the results, and I will discuss the insights, and I will present the conclusion. And so we took the consumption and generation records from a house in Vermont. Okay, in Vermont, the red line is the consumption record and the blue line is the generation record. As you can see here, there is a mismatch between the generation and consumption. When the solar panel generation is available, the load is low, and when the load is high, the solar panel generation is not available. So the battery in the electrical vehicle comes into play and helps to store the energy when it is available, and sells back or consumes the stored energy when the consumption is high or the rate is high. And another partner is Osiaco company, who produces a device called Decibel that manages the electricity in the home. It manages the electricity flow in the home. A brief literature review. Bibak and his colleagues investigate the profitability and the rationale of vehicle to grid, and say that there is some environmental, societal, and economical advantages of vehicle to grid. But they bring up some questions like the ownership problem and the tariff structure. Firstly, and please feel free if you have any question during my presentation. Firstly, who should invest in this technologies? Who should invest in solar panel? Who should invest in a stationary battery or other stuff? So Noel and colleagues, Noel et al. Consider the ownership structure in the grid, and say that under a proper tariff structure, vehicle to grid can be profitable. And Lotto and pierre-olivier consider the profitability of vehicle to home. When the selling is not allowed, you cannot sell back electricity to the grid. And they say also that under a proper tariff structure, connecting your vehicle to home can be profitable. Then Richardson et al. Consider the proper tariff structure, that how different tariff rates can influence the profitability of the V2G. And finally, some case studies are done on the V2G in Netherlands, in China, and in India. But there, to the best of our knowledge, there is not a study considering the ownership problem and tariff structure in a study. So we are going to do that. The Osiaco company suggests that there can be several investment strategies. In the first strategy, there is the basic strategy is the status quo. When there is no investment, it is a traditional consumer house. In the first strategy, we have just a stationary battery. In the second strategy, we have a stationary battery and a solar panel. In the third strategy, we have just EV connected to the grid. In the fourth strategy, we have a solar panel and the EV is connected to the grid. And in the fifth scenario, we have a stationary battery, we have the EV, and we have PV in the smart home. So they have different purchasement and installation costs, and you can see here the cost of each investment. But as I told you before, there are some questions that we are going to address in this question. First, who should invest in these technologies? And we are going to consider two agents here. First, the presumer, and second, the distributor. Is investment in this scenarios profitable for them or not? Second question is, in what scenario they should invest? What combination of technologies they should have in their houses? And the third question is, what rate should be in the grid that makes these investments profitable? And finally, we will see the consequences of using each investment scenario in the costs and peak loads. So we will go through the model, and firstly the assumptions we used in the model. Firstly, the parameters are all deterministic and given in the beginning of the planning. We have used the real generation and consumption data from a house in the Vermont. And the same charge and discharge limitation and efficiency rate are used in our model. And the real-time locational marginal price is used for the distributor's model. But we have different rates for the presumer. First rate is flat. You have the same rate during the year. The second rate is time of use. You have two rates, one for peak hours and the other for off-peak hours. The third rate is flat for general consumption and time of use just for your EV. You can charge your car when the load, when the peak is, when the load is not, when you don't have peak load. The fourth rate is the same that the distributor used, and the fifth rate is time of use for you buy electricity in time of use rate and sell it back to the grid at real-time price. We are going to see that how the investment scenarios are profitable in different combinations. We have two time steps. First, every 15-minute time steps, and second, monthly time steps. So these are parameters of the model. We have the capacity of the battery and the minimum allowed electricity in the battery, and the same for the EV. We have the charging and discharging rates and loss rates for the EV and the battery, that we use the same coefficients for the battery and EV. Then we have the cost coefficients. We have cost coefficients for the RNS, the transmission cost. Then we have the capacity cost and the rate you buy from the grid and the rate you sell back to the grid. We have the load availability of the EV. EV is not available during the weekdays, during the working days, from 8:45 to 5:15. And finally, we have the generation records, and if the trade is allowed. We see that we will consider the case where the consumer, the presumer, can sell back electricity to the grid, or he cannot. And then we have decision variables. Decision variables, the superscript show that the origin and destination of the flow. For example, this one shows that the electricity flow from grid to load at time t. And G stands for grid, L stands for load, B stands for battery, and E stands for the electrical vehicles. R stands for the generation. And all decision variables are like this. And we have just the peak load. We want to see the peak load during the monthly peak loads. We have two state variables, the stored energy in the battery and the stored energy in the electrical vehicle. And the objective, we have two linear programming models. First for the distributor, when the distributor invests and controls the system, and second for the presumer. In the objective function of the distributor, we have three terms. First is the buying cost, the cost that you pay for buying the electricity. The second, the revenue that you get when you sell the electricity to the grid. And the third part is the network cost that you pay for transmission and capacity costs. Then we have the covering, this model is constant to different constraints, is subject to different constraints. First, to make sure the load is covered. The other one is we can take energy from battery when less equal or less than the energy stored in it, and when the EV is available. Then we have the charging and discharging limits, and the capacity, the limitations for the capacity of the battery and EV. We can store energy in the battery less than its capacity and more than the minimum allowed battery in the energy in the batteries. And then we have the PV generation limitation. We can take energy from solar panel equal or less than the energy it can produce. And the state transition, we want to calculate the state of the battery, the energy stored in it in the next time step in the battery and EV. And finally, we calculate the peak load in each month and the domain of the decision variables. Then we have the model for the presumer. It has the same model, but we don't have the presumer doesn't care about the network cost, and he just want to cover his load. And also because we consider that there is a case that consumer cannot sell back energy to the grid, we added this constraint that shows we can sell back electricity to the grid when the trade is allowed. I indicates the trade. And we have the domain of the decision variables. Then we have, then I'll show the result. First, when the GMP invests and controls the system. As you can see here, we calculate the MPV of each scenario, and you can see here that the only profitable scenario is scenario number 3, when you connect your EV to the grid. The other scenarios are all unprofitable, and we use the interest rate of 6.19%, and over 15 years the lifetime of the technologies. And here you can see that when under different investment scenarios, peak loads change, but most of these scenarios, except scenario number 3, are not profitable. They don't pay off the investment costs. Then we consider the case where a presumer invests and controls the system. So here you can see that when the consumer cannot sell back electricity to the grid, we have no profitable scenario. So when you cannot sell back energy to the grid, investing in smart home technologies are not profitable anymore. But when you can sell back electricity to the grid, we can see that there are some profitable scenarios. So according to this graph, firstly, the real-time price and real-time price plus time of use are not profitable at all. But when the rates are flat rate, time of use rate, and time of use for EV and flat, we have some profitable rates. But even under these tariff rates, the first and second rates that are battery, standalone battery, and the standalone battery plus solar panel are not profitable anymore. So the investment would be, if I want to wrap up, investment would be profitable if you are allowed to sell back electricity to the grid and you connect your EV to your home. Also, you can see here that what are the, if the presumer invests in the system, how would the cost of the distributor would change? We can see here that the flat rate and time of use for EV is the best scenario for the distributor also. And usually when the presumer invests in the system, he doesn't care about the system costs, and usually the peak loads increase. You can see here that the blue line is the basic and the status quo scenario. And when he invests in the smart home technologies, usually the peak loads increase. But on the time of use tariff, on time of use for EV and flat rate, you can see that the peak loads are barely affected. And here you can see that how these can help the investment by prosumer can help the distributor. The blue line, this is the electricity in a sample week, electricity flow from grid to the home in a sample week in a March. The blue line is the basic scenario when there is no technology in the home, and the red line is the scenario number 4, when you have your EV connected to the home and you have a solar panel generation. You can see that when the rate is low, he buys electricity from the grid and stores it in the battery of the EV and sells back it to the grid when the rate is high. And finally, to conclude and wrap up, I get back to the first questions. Who should invest? Firstly, both of them can invest, and the investment can pay off if the rate structure is good. The distributor can invest and get back profit if he invests in vehicle to grid investment scenario. And the prosumer can gain profit if there is a proper rate structure. And if there's a proper rate structure, as I told you, investment made by the prosumer can benefit both prosumer and the distributor. What investment scenario should be chosen? We concluded that the scenario number 3, connecting your EV to the grid, is profitable for the distributor, and this is in contrast with the current strategy suggested by the Green Mountain Power distributor in the Vermont. They suggest that the best strategy is to invest in the standalone batteries, but our study shows that investing in the vehicle to grid strategy is more profitable. And for the prosumer, investing in the EV plus PV is the best strategy. Then investing in only EV is the next one, and investing in the battery, EV and PV is the last profitable strategy. Finally, what tariff should the distributor impose? We see that if the prosumer cannot sell back electricity to the grid, we have no profitable strategy. And if the selling back is allowed, a time of use for EV and flat rate for general consumption is the best tariff that we can suggest. Finally, there are some limitations for our work. Firstly, we consider that all parameters are given in the beginning, so this is not realistic. We know that the price is updated every 5 minutes, and we cannot, for example, forecast the load very accurately. So developing a dynamic model and solving the model using, reinforcement learning can be really helpful and make the model closer to the real world. Secondly, we considered a standalone consumer. If the consumers are allowed to trade electricity in neighborhood and invest in collective devices, it would be different from our study. And finally, if a large number of the prosumer follow these recommendations and use the same technology, probably the new peak loads will emerge, and it would impose huge cost on the network. So it would be worthy to consider this situation too. And finally, these are the references, and thank you for your time. I would welcome your questions.
All right, Seyyedreza, thank you very much for your presentation. I have one question about if you go back to slide 43, I think it was.
Yeah.
Yeah, about the tariff imposition. So could you speak a little bit more about the investment made by the prosumer increasing the distributor's costs and the role that has with the tariff, if you don't just can say a little bit about that in a little more detail, just because I thought that was interesting.
Yeah, sure. As I showed, in the objective function of the presumer, we don't have any term representing the capacity cost and the transmission costs in the network. So when the presumer invests in the network, he doesn't care about the ramping up and ramping down costs in the network. So ignoring these costs, usually when the presumer invests in these technologies, the costs increase. But using the proper rate structure can help the both presumer and the network operators to get benefit out of these investments.
Okay, great. Yeah, it was making me think a little bit about, I think like net energy metering type proposals where you have, solar panels on your house that you collect sunlight during the day, and then you basically can sort of, in a sense, you're treating the grid a little bit like a battery. And then if you're getting compensated for that, electricity that you aren't really using, and then you're using it in the, evening when there is no sun. So it just made me think about that a little bit, about the effect on the grid there. But thank you very much. Do we have any other questions from the other members of the session?
Me, Jonas.
Sure.
Just talking about Brazil. In Brazil, we have a lot of tax to insert the energy into the grid. So that's what is making the microgrid not evolve here. You pay a lot of tax to put the energy. Like I generate 100, and I only can receive 50 of the 100 of the energy that I put in the system. And then solar panels here are not being used as they could because of the high tariffs that the government put to us.
So you mean
it's a challenge here?
Paying some subsidies, government is even imposing some taxes on the green technologies, right?
Yeah, imposing taxes because of lobby of the enterprises, the power plants that have to the government. So if I put a solar panel in my house and I want to use the grid, I have to pay a lot of tax, and it doesn't work.
Yeah, definitely. Yeah, but as far as I know, in the North America, government is even paying for and subsidizing these technologies that both helps the presumer and the grid owner and operators. Yeah. Thank you for your comment.
Do we have any other questions?
No, it's okay.
All right. Well, with that, I think Jonas, you can feel free to begin when you're ready. We now have Jonas Pelajo. Thank you, Jonas. Take it away. Jonas, I think your mic is off.
Okay, are you hearing me? Okay, thanks. The paper that we developed is a game theoretical seasonalization model of the physical guarantee for hydrological plants. We did it work with Naielly that presented previously for you. Leonardo Lima Gomes and Luiz Brandão. I am a PhD candidate at PUC Rio. If you want to contact me, this is my email. Feel free to send me any email if you want to ask any question. I'll explain a little bit about the reality here in Brazil regarding the generation. In 2019, hydraulic energy generated was 422 terawatt hour. It almost 65% of the total of the Brazilian electric matrix. So as you can see, hydraulic generation is very, very important for us. When we talk about hydraulic generation, there is a parameter that is one of the main parameters that needs to be inserted into the system for the management. That is the physical guarantee. The physical guarantee represents the maximum energy that a power plant can commit in its contracts over a period of 1 year. It's not the power plant that decides the physical guarantee that it has. It's the government. They give you the license and say your enterprise has a power plant. We analyze your enterprise and your enterprise has a physical guarantee of X, for example, for 100 or any value they measure and they say what's your physical guarantee. It's in your license, but each power plant have the flexibility to allocate the physical guarantee along the months. For 1 year, the physical guarantee, total physical guarantee must be fixed, but along the months, the power plant has the flexibility to allocate between the months this physical guarantee. This process is one of the most important process of planning in electric sector in Brazil. Is made once a year and is known as the seasonalization of the physical guarantee. The seasonalization of the physical guarantee can cause the contracts and the physical guarantee mismatches between the contracts and the physical guarantee allocated. This can lead to shortages and surpluses. For example, I allocate 100 megawatts for January, but I have 50 megawatts in contracts to fulfill. So I will have a shortage here, and it will have to be financially adjusted. Okay, the individual allocations can affect also the system results, as the system total shortages and surpluses are shared. The players need to maximize their payoffs, but need to avoid the losses in consequence of the other player movements. So as you can see, the seasonalization is not only a planning process. It's a game. It's a game where if you allocate too much physical guarantee to a certain month, and that month the system is not capable to supply the physical guarantee you allocated, you can lose money. The player or the agents can lose money. So in this work, we propose a model for the seasonalization of the physical guarantee using game theory and sometimes series forecasting models to define the optimal allocation decision. I'll talk about the energy reallocation mechanism, because sometimes some region will have more favorable hydrological conditions for hydraulic energy production than others. The system is centralized. The power plants don't decide if they will be dispatched or not. There is a mechanism for sharing the hydrological risks associated with this optimization, because the management of the system is centralized. The dispatch prioritize power plants that are under a more favorable hydrological conditions, because Brazil is very, very huge country. Sometimes on the north we have very favorable condition. In the south, the reservoirs are very low, so the operator can decide to dispatch the power plants on the north and not on the south. So it would not be fair to the plants to be remunerated for the production of the energy, since the dispatch is not their decisions. In this way, the revenue that they will receive is not related to the individual plant generation. It is related to the physical guarantee that they allocate, is related to their contracts, and related to the system capacity to supply the physical guarantee that the power plants are allocated to the system. Sometimes the system is not capable to supply the physical guarantee that the agents inputted into the system. So this capacity to supply the physical guarantee allocated is known as GSF, generation scaling factor. The generation scaling factor is the gross generation of the system divided by the physical guarantee allocated to the month. If GSF is equal to 1, it's meaning that the system is healthy and is capable to provide the physical guarantee allocated. If the GSF is below 1, that is what happened on average here, because our reservoirs are very low and it's not raining as expected, the system is not capable to provide the physical guarantee allocated. So there will be a shortage, but sometimes there is surpluses. These shortages or surpluses are adjusted in the short-term market using the spot price. The spot price we call PLD, and the spot price is used to calculate the differences. Okay. Here is the payoff equation of this process. If a power plant allocates certain physical guarantee to a month, it will receive the physical guarantee that it was allocated multiplied by the capacity of the system to provide that physical guarantee. That's called GSF, minus the contract that was signed by the power plant. This term here ideally should be positive or equal to 0, but on the seasonalization process, it can be positive or negative, meaning that the payoff will be positive some months and negative in other months. The payoff equation will, this term will multiply by the price and the hours or the month, shortages and surpluses. And what about the game? Suppose that a player, now you know that there is this equation for the payoffs. What you would think to do? If I don't know the market, I would think, oh, in certain month this PLD is very high, so I will increase the physical guarantee allocation, so my payoff will be higher. So if I put a lot of physical guarantee, for example, in January, and the price in January is very high, then this term will be positive, and I will have a lot of a higher payoff for that month. But it's not true, because if the other players do the same movements, so the GSF could fall below 1, for example, 0.5, 0.6, and then the physical guarantee, you will not receive the physical guarantee, you will receive the physical guarantee multiplied by the GSF minus the contracts. Maybe the result will be the opposite that you want. You allocate a lot of physical guarantee to the month with higher PLD, but the other players made the same movements. So the GSF will be low, and you will have a loss in, will not have a surplus as you expected. This is the dynamic. You can increase the physical guarantee allocation, but GSF will penalize you. So there is a set of strategies that you can perform. We are considering here 3 strategies. The first strategy is the simple one. The player will allocate the physical guarantee according to the contracts. They will match this term here. I have a contract of 15. I will allocate 15 of average megawatt hour for that month. And I ignore the GSF, the components. Many power plants do strategy 1 in Brazil. Strategy 2 is to allocate maximum physical guarantee to the months with higher spot prices. And strategy 3 is a strategy that we observe that it can balance the benefits of strategy 1 and strategy 2. Is to use the same spot price proportion. You will not allocate a lot on the months with high PLD. Only the same proportions that the price, using the same proportions that the price. I will show you that this is a very good strategy and will lead to Nash equilibrium. To simplify, I'm going to show you a simplified game of a 2-player game in a seasonalization process for 2 periods, not 12, and these 3 strategies. And I will set upper and lower physical guarantee limits. These are the values for total capacity, total physical guarantee, the values for each player. This is the result, the payoff matrix for each strategy. If player 1 chooses strategy 3 and player 2 chooses strategy 3, their payoff is 0. But you can see that if player 1 chooses strategy 3, player 2 cannot improve the result by changing individually his strategy. If player 2 chooses strategy 1, he will lose 101 million reals. If he chooses strategy 2, he will lose 312 million reais. That's a characteristic of Nash equilibrium. You cannot individually increase your payoff by changing individually your strategy. Here, no matter the combination you can look, you will always be the strategy 3 will always be the Nash equilibrium. There is no other Nash equilibrium here or set of strategies that could be equilibrium for this game. This is a simplified game, but if you put more players and very different values for them, always strategy 3 will lead to Nash equilibrium. The payoffs here are 0 in the case that we are analyzing, but GSF is different, but we have something interesting that we call the equivalent prices. The players don't receive the prices that we call PLD. They receive the prices multiplied by GSF. This is the actual price for that month, because the price is penalized by the GSF. On the Nash equilibrium, you must have the same equivalent price between the months. If the equivalent prices are different, then it's an opportunity to change strategy and increase the payoff. For example, if in February the equivalent price is higher than in January, you can allocate more in February and increase your payoff. So it would not be it would not be possible in the Nash equilibrium, because Nash equilibrium presupposes that you cannot change your strategy without losing payoff. You will always lose payoff changing individually the strategy in Nash equilibrium. Okay. We applied this concept to a major player in the market. The first thing that we need is to forecast the load, the energy load. So we use a Cymax forecast model. Then we forecast the gross generation. The gross generation we obtain it by using the energy load minus the thermal generation, minus the wind generation, biomass generation, minus solar generation, and minus small hydroelectric plants. These values are provided by the system operator, okay, and also the forecasts we can obtain with them. And GSF is the same formula that I showed you before. Here is the result of our estimation for the gross generation, and we also receive from the operator the prices, the expected prices for the year of 2021. Okay, this is a software that they provide, and you can generate these expected values for the prices. For the optimization, what we do, when you sum the fiscal guarantee allocated to each month, it must be equal to the total fiscal guarantee of the system. That's the main objective. You cannot allocate more fiscal guarantee that you have. You have to allocate exactly the same fiscal guarantee that you have, but you have flexibility to allocate along the month. So this is the objective function, where the J is the number of months and K is the number of power plants, and the restriction is that the equivalent prices must be the same. Okay, and you have power plant capacity, lower regulatory limits for the plants. I mean, also that we put into the system. Here are the optimized results for the system. It's good that this optimization model, you can optimize the whole system, okay? And with this optimization here, and then we can optimize the player using the same proportion of fiscal guarantee that was used to optimize the system. And here we obtain the optimized values for this player that we applied, the contracts here, and here are the payoffs. As I said, the payoff is not positive in average here, because in Brazil the reservoirs are very low and it's not raining. The system now is not capable to supply the fiscal guarantee and the contracts. They have to use other sources of energy to supply the fiscal guarantee here. That's why the payoff in average is negative, but it's the best payoff that you can have regarding this scenario. Here is the result in a graph. As you can see, you have the contracted amount, the seasonalization that we perform, and the GSF corrected seasonalization that is much closer to the contracted amount to fulfill the contracts. The model was able to successfully support this visual seasonalization process for 2021, and it has a lot of potential to help the players to seasonalize their fiscal guarantee. The strategy that we are proposing is the best strategy even for the most conservative players. Normally in Brazil, the conservative players choose strategy 1, and strategy 1 doesn't protect the players from GSF variations. We show that to seasonalize using only the contracts is not a strategy that protects them. They should use even the most conservative players, the strategy 3 that we are proposing. The main contributions that we developed a new model that can optimize the results for the system and also for each player, and for a very important process of Brazilian electric system. The limitation is that in Brazil, we have a lot of discussion regarding regulatory, and we may have several changes in the next future, and maybe we will have to adapt this optimization process for the changes in regulation. That's our main concern and limitations of the use. For example, for 2022, I don't know if the rules will be the same. Okay, that's the main concern that we have with this process. But the idea is that we will be able to use for the next year and the other year if the regulator doesn't change. That's it. If you have any doubts, question, please feel free to ask. It will be glad to answer.
Joe, thank you very much for a very interesting talk. I've got a question. Could you go back earlier to the profit function, the payoff function? Your slide.
This one or
Earlier,
no, earlier. The payoff function. Okay.
So I've got a question here. So each firm controls its own physical guarantee, which is the little GIJ.
Yes,
So
that's it.
So each of the firms is trying to choose a GIJ to maximize this expression.
Yes,
given
that's it.
that the other firms are doing so as well, and that the profile of physical guarantees chosen by all the players determines GSF.
Yes, that's it.
And so the question,
Exactly.
okay, excellent. So the question that I have for you is the relationship between GSF and little GIJ. So if you're choosing your physical guarantee to try to maximize this expression, given that the other players are also doing so, is that what corresponds to your strategy 3 as a numerator in the payoff
That's
table?
strategy 3 that tries to optimize the physical guarantee and GSF at the same time, considering the other players' movements.
All right, excellent. Okay, very good. Thank you.
You're welcome.
Do we have any other questions about the presentation? Well, I've got one more question, if you don't mind, myself. Just could you speak a little bit more about the how little GIJ directly influences the GSF?
The GIJ is a physical guarantee.
Mhm.
When I will show another slide here that it will be able to see how it influences here. The sum of the GIG will determine this term here.
Okay.
This term, okay?
So that's the sum of all the little GIJs.
Sum of all the GIJs is
Okay.
here.
All right.
And here is the gross generation.
Mm-hmm.
What the system is capable to provide. So if you allocate a lot of GIG here, GSF will fall below 1.
Yeah.
Because this term will be much higher than the gross generation. So you will penalize the payoff.
Yep. No, I see that. Thank you
Yeah.
very much. That was a very interesting application of the game theory to the problem. So
You're welcome.
So if there are no other questions, we still have time, happy to, if anyone wants to have a sort of more freewheeling discussion in the time that we have remaining. But if there's no more questions or no one I'm happy to stick around and chat with anyone who wants to. But if it's Mariana, if there are no more questions, is it permissible to end the session?
Yes, of course, as you wish. If you have more comments to the participants or the speakers have any other questions or want to exchange, we can stay. But if not, there is no problem. We can end the session.
Okay. Any other questions, comments?
I have no other questions. If anyone has any comments or questions for me, let me know.
I might have a question for Jesse. I'm not an expert in the subject, but I was wondering what would be the next steps of your research. Do you think this is going to lead to some sort of best practices or advice to the heads of the government in the four corners, or how would you see your research working?
Yeah, so the research itself provides these base level willingness to pay estimates, right? So the public utilities in the four corners as a whole can try to estimate, going forward, if we want to start building community microgrids, what on average would people be willing to pay? And then they can take the results from my study and say, okay, this is a baseline, very conservative estimate of how much a ratepayer would be willing to pay. And then with the statewide heterogeneity analysis, you could even go further and say, okay, I'm in New Mexico, here's what New Mexican residents would be willing to pay. And then go from there. The thing is about these is microgrids are not, you can't just like buy one off the shelf. So like every single microgrid is going to be extremely, like it's going to be engineered for its specific purpose. And so that means there's a wide variation in costs associated with microgrids, depending on what their generation structure is. Do they have battery backup? What is the scale in which they would be providing that redundancy? And so I highly urge people, stakeholders, policy makers, things like that, to conduct original research on the type of microgrid that they might be thinking of, because people are much more, as you saw from my study, much more willing to vote for the program and pay for the program if it used only renewables. And then it might be a lot less if they plan to put in a diesel generator. And then there's also this area of not in my backyard that hasn't been explored yet. So everyone thinks microgrids are a good idea. And then you tell them, okay, it's gonna be at the beginning of your neighborhood. And then they start thinking, okay, maybe not, like it makes you think. But the purpose of the study was to provide those first baseline estimates that, going into the planning process and going to the Public Regulatory Committee, that they can provide at least some evidence that there is a non-zero willingness to pay for these microgrid infrastructure investments. And then also people are willing to pay for these investments if they don't receive the direct benefits of it. And I think that's huge, right? That's very important because, some of these public utilities in the Southwest accompany, span the entire state, right? So like, how do you get people in, southern New Mexico to pay for a microgrid in Albuquerque, which is our main city? And so this paper really goes in depth into those little niche effects of how do you get people to pay for it and who should you charge the most. The other thing is that residential specific community microgrids in this context are very new in the Southwest. And they're still under development and being researched right now by my home institution, which is the New Mexico Smart Grid Center. And we're really trying to bring that to commercialized technology. A lot of the microgrids that exist today are for industrial purposes or commercial purposes. And so this is really on the forefront of just the community perspective microgrids. And so, yeah, it's just it's to allow like the baseline conversation to begin.
Thank you.
No problem. And we would expect willingness to base to be higher because the way that the valuation question was designed was to be extremely broad and broad in aspect that you don't know the benefits super well. You know, you're asking people to make these decisions based off of a small amount of information. It's hypothetical. But if you were to actually be a utility and propose this to your customers, you might get much more rigid responses.
Jesse, I think you mentioned that. Oh, Maria, did you have another question? Sorry.
No, I was saying thanks.
That microgrids currently are more adopted by industrial customers. Do you think there's any role for something akin to municipal aggregation for you know, I know that's one way that consumers try to get rates that are a little perhaps more competitive with what, you know, larger commercial customers get, and there might be some possibility that might be something that might help or speed the adoption of microgrids. Do you think there's any merit to that possibility?
Could you specify what you mean by municipal aggregation?
Oh, sure. So it's just been on my mind because we had something like this out where I live in Ohio about a year or so ago, where basically when you enter into the municipal aggregation agreement, all of the consumers basically, essentially you bargain collectively with the utility for the rate you're going to pay. And so if that an attempt to try to lock in a more favorable rate, because if you're as a single entity, you're getting a lot more than if you're just a single, you know, household, a single consumer. And so just the idea of that kind of, I don't know, cooperation from the community level to try to speed along or make more realistic, I guess, the adoption potentially of, you know, building microgrids. But that was.
Yeah. That's always been like an issue, especially here in the Southwest. It's different by utility, how much say, you know, a customer really has. But in New Mexico and the Southwest, it's very common that if you want to make a case for rate reductions or not rate increases, like preventing rate increases, you have to go through the Public Regulatory Commission. And then in that aspect, you could do some sort of you could do some sort of collective bargaining agreement to try to get the people on the commission to vote for or against these rate increases. This also depends on the ownership structure of the public utility. Cooperative, we have a lot of cooperatives down here, but they don't cover a lot of people. But they have a lot more say in terms of how their rate changes than others. But in terms of infrastructure, capital projects and spending, that's where it gets really complicated. And I think that the industry needs more economists working on a consumer perspective, because a lot of these investment decisions get made completely without public support or input, right? No one ever asks, you know, about these things. Like no one ever says, maybe we shouldn't put in that line because we assume that the public utility knows best. And that's definitely something that keeps me up at night sometimes. So yeah, but to beat around the bush, I have not yet heard of any municipal aggregation occurring here. I do know in the Southwest, residential consumers pay more per kilowatt hour for electricity than a commercial or industrial facility, just in terms of that's how they subsidize their electricity use.
Great, thank you very much. Appreciate it.
Yeah.
There are any other questions, maybe? No? Okay. Then on my side, I would like to thank Joe and all of the speakers for a very great session.
Well, thank you very much for help making it possible. Thank you all for giving such interesting talks. It was a real pleasure. Hopefully, some point in the future, we'll be able to see each other in person at a conference.
Thank you.
Definitely.
Yes.
Thank you.
Well, yeah, continue to enjoy the Congress and have a nice rest of the day or nice evening, and depending on where you are.
Yeah.
Great. Thank you,
very
everyone.
much.
Thank you.
See you.
Bye-bye.
Bye-bye.